works. I'm going to show you one of my personal policies that I've had for a few years so that you can see that even as you borrow money out of the policy, you can still earn interest on your money as if you never took a loan. All right, everybody. So this is one of my actual life insurance policies. As you can see, the policy was started on October the 10th of 2020. Okay, so what do all these different values mean? My account value of $205,715.55 is how much money I actually have in the policy working for me. The net cash value of $13,302.86 was how much money I can access. And it has a death benefit of $2,359,223.93. And so what you can notice is there's a big difference between the account value and the net cash value. Well, what explains that difference? Well, if we come down, we see these are all of the loans that I've taken out of this policy. And as you can see, I've taken these loans out at a 4.9% interest rate, which is lower than mortgage rates. It's lower than car rates. It's lower than credit card rates. It's basically lower than any other loan rate that we can get out there on the market, because this isn't tied to federal funds rates. This is actually tied to the corporate bond rate, actually the Moody's corporate bond, to be a little bit more specific, if you really wanted to know, like, what is it tied to, right? But why is that important? What's important is the interest due, okay? So when you guys see this negative number for interest due, it means that the money is owed to me. Let me show you this. Let's click on account portfolio. And then let's show interest rate detail. Okay, so I know this looks like a lot of numbers. And factually, it is a lot of numbers. But let me try to sort through this for you. Okay. So if you were to look at all these numbers on the far right where it says balance, you can total them all up. You get the $205,000 that I just showed you on the previous screen. So in an IUL policy, the insurance company is going to credit your policy once per year, once each month. Well, sometimes twice a month, really depends. I don't want to get too complicated, but normally your policy will be credited once each month with interest. These are some of the credits that I got last year in 2023. In May, $100 there, another $200 in July, another $420 in September, another $150 in October of last year, another $326 in November, and then another $650 in December of last year, right? So if we come into this year, if we look at January the 10th, 2023, the cap rate for this policy was 8.75%, and the S&P 500 was at 3919.25, okay? There was $298.02 in that crediting segment, okay? If we look at January 25th, 2023, the cap rate was also at 8.75%, and the S&P 500 was at 4,016.22, and there's $8,000 in that segment, all right? And so that's what you want to look at. You want to look at these numbers to tell you where the starting date of your IUL segment is. And then this will tell you how much money was in that segment. Hold on. Lights just went off. So in an IUL, you're credited on your money when the market goes up. But if the market goes down, you might not get a credit, but you won't lose any money. Okay. And so if we look at where the S&P 500 currently is as of yesterday, is at 4704. So this 4704 is higher than this 3919 and that 4016 and that 4090 and so forth. So what that means is more than likely I'm going to earn 8.75% interest on all of this money in this column. Does that make sense? So to put it simply, if I'm going to earn 8.75% interest on all of this money over here, then I'm okay with paying 4.9% interest on all of that money that I borrowed. Because look at that, loan repayment. No, I do not have to pay that loan back. Guess how that loan gets paid back? Let's look.